You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
All right, everybody. That music means we are back. Once again, it is time for Options Playbook Radio, the show here on the network for all of you out there on the retail side. Maybe you want to learn some offensive maneuvers, tell you how to make some money in these crazy markets. Maybe you want to get a little speculative. Maybe you want to go on defense. You want to protect what you've got. Who could blame you in these wild times? Either way, we've got you covered here on Options Playbook Radio. My name, of course, Mark Longo from theoptionsinsider.com, as well as from the ever-scintillating Options Insider Radio Network. Hope all of our pro folks out there have been having a ball. It's double pro week, so we got a lot of great content coming at you all week long, coming into the holiday next week, where we know a lot of you will be traveling and won't have time to be tuning in live, so we're getting it all out to you there this week. And, of course, it's also Education Wednesday. It's been quite the busy Education Wednesday here on the network. All of our pro folks already got a great pro Q&A earlier today with the Oracle of New Hampshire, Mr. Matt Amberson from ORATS, breaking down all of your questions in the world of options. We just got off a great live episode of Options Boot Camp with our friend over there, Mr. Passarelli, and very much the sister show to this one here. And now, of course, it is time once again for Options Playbook Radio. If you want to get access to all that stuff on the pro side, you want to join live, ask questions, you know where to go. Theoptionsinsider.com/pro is the place to go, especially for all the exclusive stuff like the pro Q&As and the options oddities. And of course, if you're on demand, you'll be seeing Boot Camp and this episode hitting your feeds a little bit down the road. But you don't have to wait any longer to introduce your usual host here on the program, Mr. Brian Overby, a.k.a. the options guy over there at Ally Invest. Mr. Overby, welcome back to your own show, sir.
Hey, Mark, it's great to be back. And I love when we get a chance to get together and answer some of these listener questions. They definitely pile up pretty quickly. So let's huddle up and answer some questions.
It's time to huddle up and answer questions about your favorite options plays. Submit your questions via twitter.com/options, facebook.com/theoptionsinsider, or questions at theoptionsinsider.com.
All right, everybody. It's time for you folks to take the wheel with your questions, your comments. We like to turn the spotlight back on you folks here as well. So we'll kick things off. We'll warm Brian up here with a little bit of the old question of the week. This week's question of the week, Brian, is an interesting one. We've seen a lot of interest in these new We call them daily expirations, effectively just adding new expirations to the weekly cycle over there on most of your major indices, like your SPX. So now if you want to have a Monday or a Wednesday expiring contract, or you want to maybe trade in between those two, you have those options now out there, pun intended. So we thought it was a good time to pose this question to you folks, saying the new daily options and leading indexes are proving to be tremendously popular with traders. Have you added them to your trading arsenal yet? And if so, why are you trading them? Well, we gave you 4 choices. We gave you to hedge event risk, like the Fed, or pick your poison out there. Or you want to do a little bit of short-term speculation. You see an opportunity for the markets to move aggressively intraday. You want to capture that. Or perhaps you want to go a little bit intra-week. Maybe you want to buy the Wednesday, sell the Monday, do a little short-term time spread, whatever floats your boat. Or it could be the infamous other. We gave you that option out there as well. Brian, I'm curious for your sake, before we even get into the question, have you dabbled at all in these effectively daily expirations out there in products like the S, and what are your thoughts on them? And then B, why do you think our audience is trading them, sir?
I like them. One of the things that I don't like about them in general is that we have, like, if you look at the SPX, there are so many expiration dates that it's crazy. And it does sometimes, even in the SPX, can affect some of the liquidity on some of those a little bit even smaller indexes. So if we get to the point where we're doing dailies on a lot of heavily traded equities, it kind of scares me a little bit. The SPX can support them, and it's proven that it's had solid markets, and the SPY, the ETF that tracks the SPX. But with that said, if I'm doing them at short-term speculation, it is nice that you can do a long spread and just pick the days of the week that it's going to expire. But I do love the fact that you have an expensive index and those options have one day to live. And we talk a lot about the fact that, a stock like Amazon always announces on a Thursday. And it just seems like for years, I can't remember the last time they didn't announce on a Thursday. And then you have that Friday expiration. So when it was a $2,000 some odd dollar stock, it made those options really interesting to trade around the earnings, because in one day, a lot has to happen in those option contracts, because by the end of the trading day, they are going to be at zero as far as time premium is concerned. So when I'm looking at the indexes, I love the fact that I know that is going to happen. And it would be more so short-term speculation for me. If I'm hedging an event, it works, but I'm more looking at the speculation side of things if I was doing that trade. And yes, I have used them before, without a doubt.
You think our audience is leaning the same way, sir?
Yeah, I would guess short-term speculation. I like your intra-week spreads. If they really caught what that was, that would be my next choice that I would take, I guess.
All right, let's see what the audience is up to, Brian. This is our question of the week, so you can find it over there at Options. If it's not pinned or near the top, just scroll around a little bit. We have a lot of content coming out throughout the day, as you might imagine, including tweets to fun shows like OPR. But right now, it looks like we have a bit of a horse race, Brian. Got a bit of a tie. We have hedging event risk and short-term speculation, both tied right around 33% of the vote. So kind of a bit of a horse race. Then behind that, we have the intra-week spreads. I thought that would get a little bit more love, but it's not bad. It's doing about 22%, so close to a quarter. And then 11% for other. And, of course, they're not listening to my instructions, Brian. I say if you choose other, you have to tell us what your other is. And they did not write in what their other is. So they're not following along with the poll. Get over there at Options. Make your voice heard right now. Let's get out to some of you folks making your voices heard, just like Tony B, one of our pro members. Good to see Tony in there. He writes, Brian, what are your thoughts of where we go from here? He writes, Dr. Vix, that's Mr. Russell Rhodes. He's been on the network recently. He said he believes the bottom is in for equities, while other professionals, John Brady from last week's Pro Q&A, yes, John Brady from RJO was in the hot seat on the Pro Q&A last week. He said he sees an upcoming recession dragging SPX down to 3,200 before a rebound. As we're recording this, listeners, we're hovering a little bit shy of 4,000, about almost 40 handles, a little over 40 handles, actually shy of the 4,000 level, coming off the heels last week, of course, of those epic rallies, including that mother of all rallies over there post-inflation. So intriguing times. We're flirting with 4,000. Brian, our listeners want to know, what are you feeling in this environment? What do you think we're seeing next?
Well, in general, I do expect the VIX to come off a little bit. I've been bullish on the VIX all through September and October. And now we had we went through another earnings season. There's still a few stragglers that are out there. We're getting into the holiday season. The markets are looking good, relative, considering that, there's always a possibility of a recession, and we have the geopolitical concerns, of course. But I actually, on the Options Playbook Radio, talked a little bit about doing an iron condor, and I haven't talked about that very much. And the iron condor in general is just looking for the VIX to come down, getting a little bit of time decay, let the markets do a little bit of chop. And that's kind of what I foresee here going into the end of the year. But if I had the path of least resistance, so far, barring that black swan type event, I'm thinking the path of least resistance is to the upside. Usually markets do fairly well after the midterm. And, I don't see any reason why. Nothing amazing happened during the midterm elections, and they're beyond us. If you're saying inflation, if that was the peak as far as inflation is concerned, well, that's obviously another good sign. So maybe the Fed will slow down on their hawkishness, and we'll see that VIX break down towards that 20% level.
I think that's my next question of the week, Brian. Give me a little bit of a sneak peek. I think we're going to go, what are we going to see in the SPX first? 3,000 or 5,000? Let's see how folks shake out here in the market. A good holiday week question, I think, for the audience. All right, Brian, here we go. Next one. You knew something about this was coming this week. This happens to come from Kramer. Kramer says, I know Brian isn't really a crypto guy, but as a broker, does he have any thoughts on the meltdown of FTX last week? Brian, before you dive into this one, I'm sure you have some thoughts. Let me just set the scene for you. Because this week here in Chicago was FIA week, which means the entire global derivatives industry descended on Chicago from hither and yon. And as I walked into the conference at the beginning of the week, take a wild guess, Brian. Who was the super premium, platinum, top of the list mega sponsor of FIA this week, sir?
I'm assuming something with crypto.
Yeah, FTX. Yes, FTX was that. So, as needless to say, as I walked through the doors, they were scrambling to take all of that branding down and paint over it and put other sponsors up. I asked her, I said, only half joking, I said, hopefully you got that money up front because, they were above, your CMEs and everybody else. It was crazy. So, yeah, that just shows you.
The money up front, they probably ended up with a condo down in the Bahamas, I think. That's about the only asset that's left, from what I understand.
Hopefully they didn't pay him in a boatload of FTT tokens, because you all know what those are worth right now. But, Brian, I'm just saying the FTX contagion, it spread deep. They had their tendrils in a lot of different areas. So, Brian, you've been a broker for a long time. You know how it should be done. What are your thoughts on this whole, as Kramer puts it, the meltdown of FTX, sir?
Well, whenever we get a downturn in the marketplace, usually, and I don't want to say that this is a Ponzi scheme, but what happens is those events get shaken out, and there are a lot of people that have run to the crypto space. And to say that this is a surprise, I'm not saying that I would have predicted that this could have happened, but it does not surprise me. I lost, good thing I speak publicly for a living. But basically that's the concept, that you get a big downturn, usually something like this kind of shakes out, and people start redeeming, and we get to see where all the weakness is. And I love the quote by Warren Buffett saying that it isn't until the tide goes out that we know who's been swimming naked. And the tide has definitely gone out in the markets recently. And there's a couple of them that have shaken out. And as FTX seems to be the one this time around. That's simple.
Leave it to Buffett to have crafted an analogy around swimming naked. He's an intriguing fellow, I think. I think, to say the least. All right, let's keep on rolling with our questions. Actually, let's go out to the live, Brian. We got one of our pro members in the live who has a question for you. This is Mr. Nichols with a Z, and he just wants to know, how does Brian like to play holidays from a time premium and decay perspective? So, Brian, we are coming up on the Thanksgiving holiday here in the U.S. next week, so a lot of people probably have this on the brain. What is your preferred approach seeing those kind of scenarios with an options trading perspective, sir?
Well, that is interesting in that I just did tape Options Playbook Radio since I know that you are listening to this live. So it'll come out tomorrow with a lot of thoughts exactly on that topic. So once again, a very astute question from the listeners. But yeah, selling premium. I don't mind doing that. As a matter of fact, one of the things that I almost always pen an article going into the end of the year looking at covered call selling on stocks that you wouldn't mind selling, right? So you're going to have some stocks in your portfolio that you either want to take a loss on or even a gain going in, for tax purposes. Why not sell some calls on it? Even selling in the money calls. If you really want to sell that stock and you're just waiting for the year end, that's the surrogate to selling a put. So selling in the money calls, selling call writing, or doing covered call writing, this is the time of year that I always think about that. And almost every year I write some type of article about that concept and about that strategy. And tomorrow we're going to come out, I'll foreshadow a little bit with Iron Condor that's going to look at expiring after the Thanksgiving holidays. So quite simple. Straightforward. Yeah, why not? Why not? Most of the time, and Mark, you've been around a while, but most of the time on that half day after Thanksgiving, you don't get a lot of activity, but I don't know. Recently, I feel like the markets have kind of woken up a little bit on that half day. What are your thoughts on that?
Everyone's out there fighting for the Black Friday deals, so who's got time for options trading on such a day? You got to elbow that grandmother in the face to get a deal on a toaster. So that's what you got to do on the Friday after Thanksgiving. But yes, good question. Back along those same lines, Brian, let's go back to our earlier questions here. This is kind of flipping that script a little bit. Instead of getting the holidays, Allison wants to know, do you think it's possible to get some free theta days by trading long options in the days leading up to an earnings announcement? So we were just talking before about a theta decay coming out from the holidays. Allison kind of flipping that script saying, we got an earnings event. Maybe you don't get the same decay leading into that. Have you played around with this at all, Brian? Trying to play and trade in the days and maybe even hours leading up to an announcement. So you're trying to get effectively a cheap or even perhaps, as she wants to know, a free swing of the bat without having to pay the decay tax.
Well, yeah, but not in that exact format. I mean, what I've always looked at, Allison, is calendar spreads, diagonal spreads leading into an earnings report, and more so the fact that I don't want to go into the earnings. So I like to, let's say we have earnings coming out 1 month from now, go out and buy the option contract that contains the earnings and sell maybe a 2-week or a 3-week option contract that does not. So you're hoping that that one will expire, the shorter term option, and then the back month option, which would have an expiration date that would contain that earnings, will get that bump up in implied volatility. So to me, it's always more been about calendar spreads, diagonal spreads, those type of trades, because I want to take that volatility piece out of it. And a lot of people don't even think of the fact that if I go long a calendar spread or a horizontal, many different names for them, that I am actually long volatility, because if your trade works out right and the front month expires worthless, right, or close to worthless, you want it to be kind of at the money a little bit, then I'm long an option. And if I'm long an option, I want implied volatilities to go up. So you take out one of those components because most of the time, I can't say all of the time, but most of the time, the implied volatility on that option contract that you are buying that has that earnings date is going to increase as we get closer and closer to the earnings. So yeah, I've definitely done it, talked about it a lot, but more so on the horizontal and diagonal spread strategies.
All right. Let's see how many people we could squeeze in here in the time we got remaining here. Let's go to, I like this handle, Tidbits with a Z. Tidbits with a Z wants to know, it seems like 0-day to expiration trading is becoming more popular these days. Yes, Tidbits, I was just talking about that earlier today on our pro Q&A session earlier today. Seems like everyone's obsessed with it. Tidbits wants to know, is Brian seeing this trend play out with ally customers as well? Yeah, Brian, as I mentioned, I was just talking about this earlier. It does seem, we've been doing this for a while here on the network. In January, it'll be 16 years, which is scary to say out loud. But in that time, I can't recall as many people writing in and asking and mentioning this whole 0-day to expiration phenomenon, effectively trading on expiration day. So Tidbits wants to know, Brian, are you seeing this over there at Ally as well?
Well, I would have to actually go in and do a report on it because I haven't really thought about it in that aspect. But people are becoming more and more astute as far as understanding how the Greeks work as expiration approaches. And if anything, I talk about it all the time. I actually have a few YouTube videos about using the Greeks to try to set up your strategies and just understanding how the delta reacts relative to the theta and the combination between theta and gamma, which that's really the biggest relationship, the acceleration relative to the time decay. And, you can't have one without the other, right? If you want high acceleration, you're going to have high time decay. And so it makes it interesting when you're doing an option strategy to know that, oh, by the way, the time decay is going to be 0 on the market close today, or the time value of any option is going to have that. So you can, it just gives you a variable that you can kind of plan for, and understanding that, but also understanding the risk that goes along with it. So I can't speak specifically if I'm seeing ally customers doing it, but once again, been talking about it for a long time. Same with Mark.
I have to imagine maybe some of the uptick we've seen recently has to do with what we talked about at the top of the show, right? With the explosion of daily expirations and a lot of big products. It's a lot easier to do now than it was, let's say, when you and I first got started, right? When there was one day a month you could do it, Brian, and that was it. Now you can have a 0 days expiration trade pretty much every day of the week if you really want. So if that's your style, you have many more options, pun intended. So I'm sure that has something to do with it as well. It's just easier to do than it was, let's say, a decade or two ago when you had one day and that was it. Not to say it wasn't done back then. I remember guys on the floor of the SIBO, Brian, who you'd only see them on expiration day. They would show up and that was it. So there has certainly been an audience for this style of trading. It's just not for everybody. It's intriguing, though. Maybe we'll have to be a future episode of the show, Brian, all about the madness of expiration day trading. But I digress. Let's get to this question here from this is the handle, MLCCT. That just rolls off the tongue. MLCCT wants to know, does Ally accept PFOF? And then what is Brian's view on the SEC's review of PFOF for brokers? PFOF, of course, listeners, if you've been under a rock, payment for order flow, it's been a hot topic. It's been one of the reasons why a lot of brokerage stocks have been flipping all over the place, places like Robinhood and others. It's been very contentious. The SEC have issued a lot of interesting rulings on that recently. It's also, a lot of people think it's a new phenomenon. This has been going around and going on forever. This was something that was contentious back in the late 90s when it was really first starting to creep into options, and there was a lot of hand-wringing about it then. So this is not by any means a new phenomenon, in spite of what you might think by reading books like Flash Boys and others. This has been around for a while, and it's been very contentious for a very long time. Brian, MLCCT, Getting us out of here on a fun one. Maybe we'll have to find another a little more cheerful question then. But MLCCT wants to know, does Ally accept PFOF, and what is your view on the SEC's review of payment for brokers, sir? A lot to go there.
Well, yeah, we accept payment. I don't know many that don't, because it's, it's zero commission. It's that simple. So the thoughts are, if it goes away, do we start charging commissions? And there are a lot of underlyings, like you look at the SPY, the extremely tight underlyings, there's no payment for flow. So if you get a lot of the extremely high traded, high volume, if there is payment for flow, it's very minimal, because there's really not, the market's so tight. You're penny wide in the SPY all the time. I don't want to put my foot in my mouth and say that there's no payment ever. But so on a lot of the extremely volatile, extremely tight markets, payment for flow is minimal to zero anyways. And that's what a lot of the swing traders are trading. But then if you look at banning it, well, then what happens to commissions? So do you want to pay zero commissions or not? And I don't know. I really don't know how it all plays out in the end. And Mark probably has a little bit, even though I work for a broker, Mark probably has a little bit more thoughts, because he's talking to more of the brokers in the space as to, could we go back? Could we see commissions start being charged in a lot of equities if the payment for flow goes away?
It is a very delicate balance. You're right. And I was around there early on when there were pits on the floor that were sending reams of data to the SEC. This is back in, 99, 2000, when all the multiple listing was really hitting the options market for the first time. And they were sending data saying, look, there's demonstrable trade throughs where the customers are getting disadvantaged because broker X is getting paid more to execute a trade at one facility or one venue versus the other. That's obviously changed. A lot has changed in the intervening 20-odd years of all that fun out there. So the notion of trade throughs, we've established things like linkage. A lot of things have gone on in the marketplace to safeguard customers out there that didn't really exist in the early days of this. So it makes it harder for a lot of people out there who are looking for these types of discrepancies. But that said, it is a contentious issue. A lot of brokers like Robinhood and others, they lean on this as a way to be able to deliver you the commission-free trading. And especially in the environment until this year, when rates started kicking back in, brokers really have a couple of reliable transaction areas, right? And revenue streams. They have, of course, transactions and commissions. We all know what happened to that. There was margin, which we all know what that's been until this year. For the better part of the last decade, margin hasn't exactly been the revenue generator it used to be. And so the other leg of that stool was payment. And so there were a lot of brokers that had designed a lot of their setups and a lot of their structure around payments. Now that the SEC is they've punted on this for a long time. If they do finally decide to change their stance, it would be interesting to see the impact. It is challenging, though, at the end of the day, to put that genie back in the bottle. So I don't expect us to see a complete flipping of the script, a complete turning of the time machine wheel back to the days before everyone got rid of commissions. I just don't think we can do that as an industry. It's kind of done. The genie has left the bottle. It is challenging to put it back in. It's also challenging. I don't want to end on that note, Brian. That's not fun.
That's fair. Yeah, that's a tough one, because I don't know the answers. I don't know. Charles Schwab, when they went to zero commissions, knew what they were doing, and they bought up a few brokerage firms.
Yes, they were buying TD for pennies on the dollar. That's what they were doing.
Right. So they knew what they were doing. So it kind of shook itself out, anyways. When that happened, it definitely shook up the brokerage space and made it very hard for newcomers to come in.
A lot of people were saying what that Binance guy did with FTX last week is shades of what Schwab did with TD, right, to get rid of commissions.
Right.
Obviously, Binance cutting their legs out, and then, they were going to buy them for pennies on the dollar. Then they kind of walked away from the whole thing. But either way, they did manage to undo a competitor. So intriguing stuff. Brian, I grabbed another question. It's kind of been lurking here for a while. On the surface, it's kind of a straightforward one, but it can also be a deceptively deep question. This comes from Flyer, and Flyer simply wants to know, what are some of the best ways to trade put options? That's a silly one to end on, Brian. You have many pages, many chapters of your book devoted to put options. What are some of your favorites for Mr. or perhaps Mrs. Flyer?
Well, I guess one of the biggest things to think about is, just buy. I like to do collars. I like to do collars on stocks that I'm a little bit nervous about, or I'm nervous about an event. And a collar is the fact that I would buy a put and obviously buy it for protection. But if you're buying it for protection around a known event, they're going to be fairly expensive. So one of my favorite ways to trade a put option is on a stock that I own, go out and buy that put and then sell a call to help pay for it. Just a simple, good old collar strategy. It doesn't get talked about too much here. I don't maybe talk about it enough on Options Playbook Radio, only because I don't know, it's not a very exciting trade. But that is one of the ways I like to approach put options. But then again, if you're just looking at puts and you want to get bearish on the marketplace, puts are a great way to do it, a great alternative to selling stock short and even buying in the money puts. A lot of people, I see them when they're speculating, they're always buying out of the money puts to try to get short on the marketplace. Think about buying some in the money puts every once in a while, much the same way that we talk about it with the call options on longer term calls on stocks that we wouldn't mind owning. I think I recently did a show on Caterpillar, bought some out of the money longer term calls on Caterpillar after their earnings announcement. Like, that's a great example. You want to get long term short something. Think about going and long term with puts. I'm, talking a couple of months out in time. I'm not looking probably at 9 months or so, but interesting alternative. That would be interesting way besides the norm to just trade put options.
All right, some more fun one to get out of here on than PFOF. That music means we've come to an end here, listeners. If you're one of the many listening on demand, you're hearing this right around Thanksgiving time next week. So hopefully you and yours are having a great Thanksgiving holiday if you're here in the U.S. If you're one of our international listeners, have a good time, relax, get away from your screens a little bit, and be thankful for the friends and family you got around. Just always a good thing to do here. It doesn't have to be limited to just our U.S. listeners. And Brian, before we go, if folks want to reach out to you to participate in future huddles, maybe they just have a question they want to send your way, where should they go? What should they do?
First of all, follow me on Twitter. My handle is @BrianOverby. I tweet about all the educational events that we do at Ally Invest. And then you can also just email me if you have any questions. Email them directly to me at theoptionsguy@invest.ally.com. Thanks for listening. Have a great holiday, and may all the options that you buy finish in the money, and all the ones that you sell finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.